Banks are sending out more requests for annual salary information from their customers. Wall Street Journal personal finance reporter Amani Moise joins us to explain why and whether customers are obligated to respond. So Amani, wouldn't the bank already know your annual income? They could get that from the credit reporting agencies or figure it out based on your credit card spending or your direct deposits, right?
It's interesting that you say that, and you would think that your bank knows everything about your financial life. However, how much money you make tends to be a place where they're typically flying blind. So the monthly credit reports that they get from agencies, they really only tell a bank how good you are at paying your bills, not about how much money you're bringing in. And outside of your primary bank account, where you maybe have direct deposit set up, most credit card lenders don't know how much people make.
So do they want to know just your salary or all of your assets like your investments?
They want to know your earnings. So if you have investment income, you could include that. If you have something like child support payments or some other type of annuity, you could include that. And you could even include your spouse's income. They just want to know how much money you have coming in available to pay your bills in a worst case scenario.
My name is AB Ridgeway. I'm with the Ridgeway Report. And yes, this is true. Banks really want to know your income. Now, there's a couple of reasons why, and she touched on a few of them, which are very important. Lending is very important. When you're talking about accessing capital, whether it's through a credit card, a personal loan, a home equity line of credit, creditors want to know, can you repay your debt? And how are you going to repay your debts is if they have an established income stream where you can actually do that. If you're only making $100 and your car payment is $400, a lender is going to say, how are you going to pay the monthly bill if you're only generating $100, right? And vice versa. If you're making $10,000 and they say, hey, it's going to be $400, they're going to go, you'll be able to afford it. Now, don't get this confused. There is a number they call a debt to income ratio, right? So that means how much debt do you have versus how much income do you have? Because this is going to take everything in consideration. Now, you can have a car loan. It says $400 and then you make $10,000. But what if you have other debts? Let's say you had a business and you owe taxes on the business and your monthly bill is $10,000. Well, that's $10,400 for your debt and you're only getting $10,000. That's going to be a red flag. So it's not just the income. It's your debt to income ratio. And the bigger that ratio, where the distance between your debt and your income, the more likely a creditor is more willing to loan you money. Now, taking into consideration, that's not the only thing that they consider. They also consider the fact of how many people are you paying and how much people are you paying on time based on your credit report. Now, if you can make $10,000 a month, but if you're not paying your creditors, that lowers your score and lowers the probability of them actually getting their money. So when they want to know your annual salary, it kind of helps them determine how much money they can lend you and what is the probability of you paying them back.